It gives me great pleasure now to bring on board someone who I've never had the chance to interact personally, but I've been tracking his work. I've been reading I've read his book, and he's someone who is a standout investor in the otherwise crowded world of value investing. That's Guy Spier for you. It's an extraordinary pleasure to have you on ET now. It's not your first time, but it is my first time with you. So a very warm welcome.
Well, it's great to be here, Nikunj and Abha. And I feel like you're in the room next door, actually. So India's not that far away. I'm actually here in Switzerland, where I just closed the window to make sure that the sound of children playing outside my window don't interfere with our interview. But it's great to be here.
Normally in a market interview, our first question is, what is the outlook on the market? But no, that will not be my first question. What perhaps me and Abha want to start with is that, how do you think this current crisis will change the world? And when do you think we will go back to normal life?
Yeah, well, I've been an optimist throughout this crisis, and it's not been to my benefit. I've consistently underestimated the impact of COVID-19 on the global economy. And as I was saying to you and I've said to others, I think that I was right in assessing the impact of the virus as being way less than people expected. But what I didn't understand was the extraordinary panic that effectively set in amongst policymakers to take some really outrageous actions which have damaged economies around the world. And but I'm still an optimist in that when I read articles that say that business travel will never come back, or it'll take 3 years for business travel to come back, I don't think the minute the heavy hand of the governments that are trying to show that they're doing something are lifted, I think the vast majority of human behaviors will go back to the way they were before. How long does that take? We know, I'm not saying anything you don't know, so forgive me for repeating what you do know. We know that a vaccine is going to come sooner or later. And I think that increasingly, even without a vaccine, as we allow people freedom to decide their own lives, older people will take the precautions that they need. Younger people will decide how much risk they want to take. Different businesses will decide how to configure themselves for, just to give you a sense, this Saturday night, coming tomorrow night here in Switzerland, the cinemas are opening again. I don't think we've booked yet, but I think that I and my family will be in the cinemas. And we expect that the cinemas will take some precautions. And based on my reading, I feel quite confident that if I'm not in a bar, I'm not in a place where people are breathing heavily right next to me, I think there's no issues at all. So even without a vaccine, I think that people will realize, hey, I have to live my life. And so things will come back to normal way faster than most of the doomsdayers are expecting. I don't know if that was a helpful answer.
All your answers are helpful, Guy, please. No, just before we started, and also as you were speaking just now, you've talked about how the impact of this could be seen for a long time to come. And at the same time, we're seeing markets go to, record after record. So as a value investor, the question I have is, have I missed the boat?
Well, I went into this pretty fully invested, and it was shocking to me to see Warren Buffett so bearish at the Berkshire Hathaway meeting. And I decided that I had to find things in my portfolio to sell, such that, it's still not an enormous amount of cash, but I think I'm at about 15% cash right now. I think that a big part of the bearishness of some of these old school value investors like Warren Buffett and Sam Zell and Howard Marks is that they've kind of built their careers on financial prudence and the expectation that from time to time the markets will go haywire and they'll get the opportunity to buy. And while they don't want to wish any bad economic outcomes on people, they kind of thrive when things get dislocated. Except in this crisis, what happened was that the Federal Reserve of the United States and other central banks stepped in and made unlimited money available. And so they were kind of shut out. And, you know, it sticks with me every time Warren Buffett saying, look, they had to do what they did, but we don't know what the consequences are. And I think that if something were to happen that would take away the willpower of the central banks to keep providing endless liquidity, unlimited. I mean, the governor of the central bank, no, what do you call it? The Chancellor of the Exchequer of the UK, Rishi Sunak, he famously said, whatever it takes to take care of you. And that is way beyond Alan Greenspan. Alan Greenspan was accused of spiking the punch bowl. And here we have central bankers telling the markets whatever it takes, which is just extraordinary. And the markets are taking them seriously. They're saying, well, yeah, whatever it takes, we think that you're going to inflate these markets perhaps to infinity. Warren and Howard Marks are saying, well, maybe there's something that comes up either in the near term or in the next 2 years that takes away their willpower to do that.
So, Guy, Buffett famously says, interest rates, they act like gravity and they bring stock prices down. Now, we are in a world where interest rates will remain low for a long period of time. There is a lot of liquidity. There is a compulsion to invest. I'm trying to understand that if you don't invest now, and you'll be stupid to invest in the bond market, equity perhaps is the only game in the town.
Yeah. You know, the simple answer is what Charlie Munger says is, you know, Nikunj, this isn't supposed to be easy. But you're absolutely right. You've just presented the conundrum. And how do you deal with that conundrum? Do you go to cash and miss out on equity market rises from here? Do you go to bonds? That seems to be a dumb idea. Or do you stay invested in some extraordinarily inflated, what appears to be an extraordinarily inflated stock market? And then even within equities, you have the question, do you invest in the market darlings, which just seem to go from strength to strength? Or do you stay dyed-in-the-wool classic value investor where all that happens is that your stocks continue to go down, you know? Very, very tough time. But I tell you something, Nikunj, I've been doing this now for more than 20 years, and it always feels like the previous years were easy in comparison to the way it is now. And we will look back in 5 years' time or in 10 years' time and say, wow, if only I could have been investing in 2020, it was easy then. You know, so it always looks easy in retrospect, and it's always difficult looking forward. We have tough and treacherous choices to make. I can tell you that one of the conclusions that I came to, I was not so you know, I'm anticipating a question that you probably have, so I'm just going to dive into it because it's also in a lot of people's minds. How can you be a value investor today? And how can you be a value investor when all the businesses that seem to be doing really well are businesses that appear to have very, very high valuations? And, you know, I'll just give you a couple of simple adjustments. So if you're in the enterprise software space, you will have marketing expenditure that you spend to grow the size of your business. But that marketing expenditure goes away the minute you go into steady state. You have to make that adjustment and look at the earnings of the company without the growth capex, if you like, or the growth marketing expenditure. If you make those kinds of adjustments, there are some very smart value investors who come to the conclusion that, who have in the past or today have come to the conclusion that some of the FANGs are actually great value investments. One of the decisions that I've taken is I can't just be in, I don't own Procter & Gamble, you know, packaged goods companies, but I can't just be invested in those kinds of companies. I have to engage with and understand, you know, Facebook, Google, Twitter, Salesforce, all of those new economy companies, because there are some extraordinary economics that are coming to bear there, and you have to factor that into your valuation model. I actually thought, Nikunj, here's your and my problem, I think. But maybe it's my problem, not yours. That I actually thought when I started doing this 20 years ago and I worshipped at the church of Warren Buffett, is that all I had to do was find newspapers in one newspaper towns. And I thought I could live the rest of my life happily and safely finding newspapers to invest in. And even Warren Buffett had to disabuse himself of that. And, you know, I would really prefer that world, but that's not the world that's been offered to me. But, you know, maybe you can teach an old dog new tricks. Maybe I can become as good an analyst of the Amazons and the Googles and the Spotifys of the world as I can of the newspapers. And it's hard. It's really, really hard to do. But I think that that's what is required of people like me.
You know, Guy, things have been turning upside down in the last few months, and you've touched upon a couple of those points. So would you actually go and include a bit of everything in your basket, or would there be one resounding theme that you would actually be confident on, given the upheaval we've seen, given the likelihood of the implications of this actually playing out over the long term?
You know, it's a great question. And so, you know, I get rarely asked this question, but I used to get asked this question. Actually, I still get asked it. They ask me, what do you do, Guy, about currency risk? So, for example, my investments in India are not hedged back to the US dollar. It's just an investment in the Indian economy. I'm not hedged there. And so, and they say, well, what if you can see that the Indian rupee is going to rise or fall over the next 3 or 4 years? First of all, I don't know that. Second of all, if there's any major impact on my portfolio that I don't know, I kind of want to be equally straddled on both sides of that equation. And so I think that the answer is you want to assess all of the things that you don't know that do have an impact and be equally straddled. So I don't know if the FANGs are overvalued. But I used to be of the kind of person who said, well, I will never allow myself to buy a company at 10 times revenues. And one of the companies I'm looking at is priced at 10 times revenues. And now I'm willing to say, well, hang on a second. It is a software company. It does enterprise software. There may be, if you look at the kind of adjustments that I talked about, that it actually does make sense. But I don't want to be 100% in that. You know, what to do about interest rates that are down at zero, equity markets that are through the roof, bonds that aren't worth anything? Well, hold some cash. Would the value of your cash be eroded in an inflationary environment, and does the cash earn nothing? Yes. But the cash is extraordinarily useful if it turns out that we're in a bubble and it gets pricked. And so the ability to straddle all of those things and hopefully straddle all the things that are important, you know. Actually, I feel much happier now with a substantial level of cash than I did going into this, where I had far less cash. And my answer on that question of the new economy, those companies are not necessarily overvalued. They're extraordinary businesses. As Warren Buffett said, they can grow without consuming capital. You know, if I own an automobile company, it can grow, but it consumes a lot of capital to grow. Whereas Google just sits there and more people click on their websites. They don't, you know, they have to buy a couple of servers, which cost them nothing. That is, and that may be justify the high valuation.
So you're saying that would still make a case going ahead. Where do you see, Guy, a case for low risk, let's say?
Lower risk where?
High uncertainty. Yeah, but where would you see low risk? Across the markets, you know, would there be a region? Would there be a certain theme? Where would you see, even with high uncertainty, low risk?
I mean, the real question is, hey, you can get really low risk in government bonds right now. It just doesn't offer you very much return. So, you know, but low risk and the prospect of a higher return. I mean, you know, I would argue that, so this is my perception, but, you know, what is, when there's an event like this, then people focus on the charismatic aspects of the event. So the streets are empty, you know, we're convinced nobody's going to visit a shopping mall again, nobody's going to visit retail again. So I think that nobody's going to fly again. And I think that all of those places where there's a very, very high perception of risk, nobody's going to, sorry, I'll go on to a couple more. Nobody's going to use a cruise line again, and nobody's going to buy any oil ever again. Because, of course, we all see the oil price go negative a month ago or so. And I think that, things will revert very nicely to where they were before. I've spoken to some very smart people who think that the cruise industry is dead. I don't think that the cruise industry is dead. I think there'll still be people who go on cruises. I think that we're all sick of Zoom. We can't wait to meet people and press the flesh. I don't think that careers will be advanced if people don't press the flesh. I think that we just want to get out of our house and watch a movie in the movie theater. Music and entertainment, I don't think that people are not going to want to go to concerts anymore. So I think all of those areas actually represent some extraordinary opportunities for people who are willing to be a little braver and go out on the curve a little bit, And, it's been a period where to be optimistic has been punishing, unless you're optimistic about the FANGs. If you're optimistic about retail, airlines, business travel, entertainment, all of those things, you've been punished very badly. But sooner or later, it'll become worthwhile to be optimistic about those things again. And exactly when that turning point is, that is a great question. And, I was convinced going into this that this was a 3 or 4 week thing. I didn't think it was going to be longer than that. It's actually turned out to be much longer than that. But and like Howard Marks said, when is the bottom? It's the day before things start going up again. And we don't know when that day is. Day might have already passed. And, I know that both of you have had the experience where, it's sort of like you either buy a stock where you're convinced that it's bottomed, and then N days or months or years later, it crashes through the price that you paid for it. Or, the stock has been on a tear. I've experienced this where I say, I really need to buy this so that I own it, because it's never going to see these prices ever again. And you race in and you buy it on the way up, and then 3 weeks later, it's well below what you paid for it. Who knows is the answer. And the answer to that, for what it's worth, is have a healthy commitment to equities, but also have a healthy amount of cash ready in case something happens. And just to go, sorry, I'm answering, almost anticipating questions of yours, but what really scared me after the Buffett meeting or the Berkshire meeting was, wow, Warren Buffett is really not sure that the central banks will continue to hand out the candy, so to speak. And, what I realized was there could be a scenario in which, even though the central bankers want to continue to hand out the candy and make liquidity available wherever it's necessary, there may be simple cases where they've just quite simply precluded from doing so. We had an issue, I don't know how closely you followed it, where a German constitutional court ruled that the European Central Bank was in violation of its charter in engaging in some of the actions that it did. And people were worried that the European Central Bank may be forced to have the punch bowl taken away from it. Or in the United States, I started thinking through scenarios where, what happens if one of the presidential candidates decides that it's in their best interest to convince the Federal Reserve to take away liquidity because it creates a crisis that is actually to their political advantage? And, I can't see it right now, but it could be that if you get a Democratic president in, that they decide that they want to accentuate the crisis early on in their presidency, and they decide that they don't mind alienating business because those aren't the people that elected them. And you end up getting a central bank governor who's under a lot of pressure to take away liquidity, and the markets crash. So, we can't rule out, none of us can rule out that there's an election in the United States, the Democrats get in, and they convince the governor of the Federal Reserve governors to take away liquidity from the markets, and there'll be a massive tumble in the markets after the election. Who knows? I just made a bunch of bears really happy.
So What's been your experience in India? Good, bad? You've been surprised or equally surprised? I mean, in the good way and the bad way, both with Indian promoters, Indian businesses?
I'm extraordinarily optimistic about the future of India. Look, India's going to end up saving us, you know? The United Kingdom, extraordinary country, was saved by the United States, you know? United States, 300 and something million people. India's, India's not quite ready, but it's going to happen in the next 50 years that India is going to save liberal democracies.
Guys, so, I will not extend our appointment much with you. I just want to go back to a very simple principle, and that principle is cloning. Mohnish has referred to cloning.
Yeah.
You follow Buffett. It's good to clone his portfolio, easy way to get rich. But I can notice that there are hardly any common stocks between you and Mohnish, even though you're great friends.
Yeah.
Do you think it's important to be an original thinker and not get in the trap of cloning?
You know, Abhay, I can see why you enjoy your work with Nikunj. Really, you ask great questions. We could write a book on cloning. And where to start? So, point number one, it would be really dumb to clone the wrong things. So, Mohnish and I joke at the Berkshire meeting. We sit together and we joke that every time Warren Buffett puts a peanut brittle into his mouth, I'll put a peanut brittle into my mouth. Every time Warren Buffett drinks a regular Coke, I'll drink a regular Coke. But on some level, that is not the way to clone Warren Buffett. And here's another way not to clone Warren Buffett is that often, and it's not that hard to see, there is a divergence between what Warren Buffett says and what he actually does. And I can't come up with any examples right now, but that is certainly the case. So we need to, quote, clone the right things. We need to absolutely copy the right things. Another thing that I've learned, if you're talking about copying other people's investments, look, there's no question that, if it's been through their filters, you already know that a whole bunch of due diligence has been done, which is certainly comforting. But another investor could have committed a very different proportion of their portfolio to that investment, and they may see it in a very, very different way. They may have made the investment in the equity of the company because they actually want to become a lender to the company or because they want to acquire the company. I mean, I followed Brookfield Asset Management into a North Sea oil service company. And they made the investment not because they wanted the shares to go up, because they were able to use the relationship with the company that they got through buying the shares to create a transaction that benefited them but didn't benefit me. So, you also have to be aware that just copying what Warren Buffett does not necessarily lead to success because he's playing multidimensional chess on a different chessboard, with a different set of pieces and with a different set of opportunities. So cloning has to be done intelligently. You can never be stupid about it. I also think that, so if you look at what I came to, when you look at, let's say, my portfolio and Mohnish's portfolio, I've gained increasing understanding that Mohnish is a different personality to me. And what he is able to do, even if I get the other things right. So Mohnish runs a much larger portfolio than I do. He's a different personality with a different set of investors. And so, again, like me and Warren Buffett or me and Brookfield, we're all playing multidimensional chess, but with different chessboards. We're not on the same chessboard. We don't have the same position. So there are investments that Mohnish can make that just from a pure psychological standpoint, he can handle, and I can't. All of the Indian investments, and I spent quite a bit of time looking at his Indian investments. He would, I guess, get advanced warning of something based on his read of the newspapers versus somebody talking to him versus the way the letter's written. I can't rely on that. I can't rely on Mohnish calling me up and telling me second by second how he's reevaluating the situation. I can't do that. So that's part of it. But I would, interestingly enough, for me personally, I think that there are a number of opportunities that I saw clearly enough that I missed because I was slavishly trying to follow a certain style, which was actually not my own. And there's this great question, what part do you clone and what part do you allow to original thought? There's the famous cartoon of a man who's looking at a cat, and the cat is got his box, and the cat's just got and pooped outside of the box. And the man's looking at the cat and he's saying, never, never, ever think outside the box. But because I slavishly followed, I sort of saw these great businesses in Google and others, and I said, no, but I can't do that. Warren Buffett's not doing it. There must be a risk there that I don't see, and I'm better off just slavishly following Warren Buffett. At what point do you there's another famous statement by Charlie Munger that I just love. Never underestimate a man who overestimates himself. And he was talking about Elon Musk. So just because somebody thinks he's great and is doing really well, that's not a reason to short them. And they may continue to be very successful, but they may actually be totally overrated as human beings. So that's what he was in a certain way saying about Elon Musk, but not directly. So at what point do you step out from under the shadow, say, of somebody and say, well, I'm not going to just strictly clone. I'm going to allow for independent thought of mine, and I should be confident in that. Getting that right and understanding which is really, really hard, really, really hard. And Nikunj and Abha, all of your questions are hard questions to answer because you're going to the core of it. And at the core, what you get down to is the human condition. We want to do well for the future, but we don't know what the future holds. So we have to try and make the best decisions for today. And I think that the answer there is, Henry Ford had this famous thing. He said, at least until the age of 40, you should consider yourself getting educated. Well, let's just say that that's now 50. So, you're acquiring an education. I think don't even think thinking outside the box until you've got quite a bit of experience under your belt, and then start diverging very carefully and thoughtfully.
Guy, I think we'll leave it there. We've taken a lot of your time, and you very patiently answered a lot of our questions. And we really enjoyed speaking with you today. I hope we do it more often here.
Yeah, delighted to do it.
And under better circumstances next time.
Also happy to come visit you in real life. That would be great. I'm looking forward to that.
Thank you very much.
Yeah, thank you.
Nice talking to you. Thank you.